Today, we are exploring the choice between cash basis and accrual basis accounting. We talked a little bit about this in episode 3, where we guided you through the process of setting up your accounting processes for your business. But in this episode, we are going to dive deeper into the topic because it is so important. We'll talk about the differences between the two methods, how you choose between the two, and what the legal requirements are for each. This is a decision that can significantly impact your financial reporting and tax obligations, so it's important to understand each method and make sure that you're making the best choice for your business. Let's get started. To kick things off, let's clarify what cash basis accounting is and how it works. Cash basis accounting is a straightforward method where you record income and expenses when cash actually exchanges hands. In other words, if you receive a payment from a customer today, you recognize that as income today. And if you pay a bill today, you record that expense today. Cash basis accounting is often favored by small businesses because it's simpler and easier to manage. And then because of its simplicity, it's also usually a cheaper option if you're outsourcing your accounting to a third party. It reflects the actual cash flow of your business and makes it easier to see how much cash you have on hand at any given moment. But it's important to note that cash basis accounting does have its limitations. For instance, it doesn't really provide a complete picture of your financial health since it doesn't account for revenue that you've earned but you haven't received yet, or expenses that you've incurred but you haven't paid yet. On the other hand, let's take a look at accrual basis accounting. This method records income and expenses when they're incurred, regardless of when the cash actually changes hands. It provides a more comprehensive view of your financial transactions by capturing accounts receivable and accounts payable. Accrual accounting is often used by larger businesses and is generally accepted under the generally accepted accounting principles. It matches income with the expenses that generated it, which provides a more accurate reflection of your business's profitability. It is essential to understand that while accrual accounting offers a more detailed financial picture, it can often be more complex to manage. It may also result in higher taxes in certain situations because you're reporting income when it's earned and not when it's actually received. Let's look at an example, and I can walk you through how you would record it under each method because I think that will help you understand the difference better between the two. So let's say that you own a business that sells machinery. If you sell $5,000 worth of machinery, under the cash method, that amount is not recorded on your books until the customer pays you when you receive that check, which could be months later. On the other hand, under accrual method, the $5,000 is recorded as revenue the day the sale was made. So when you send that invoice to the customer, you get to record it as revenue right then and there, even though you might not receive the money for days or months. The same principle applies to expenses. So let's say your company receives a utility bill for $500. Under the cash method, you would not have to record that as an expense until you actually pay that bill because that's when the cash is exchanged. However, under the accrual method, the $500 is recorded as an expense the day that your company receives that bill. So how do you choose between these two methods? Well, now that we've covered the basics of both methods, let's explore the factors that should influence your choice when you're choosing between cash or accrual basis accounting. So first and foremost, accrual accounting is required for companies with average revenues of $25 million or more over 3 years. So if that's you, then this decision is already made for you. You have to go with accrual basis. But if that's not you, the nature of your business can be a significant factor. If you are in like a product or service-based industry where payments are delayed or you have a lot of accounts receivable, accrual basis accounting might be more suitable for you so that you can match your income to your expenses. To add to that, as a general rule, businesses that carry inventory, even if it's small, typically use accrual basis accounting because the cash method doesn't properly account for cost of goods sold. On the other hand, if you operate like a small retail store or restaurant where transactions are generally settled in cash or credit on a credit card immediately, then cash basis accounting is simpler and totally fine and appropriate for your needs. Another crucial factor is, of course, tax planning. Accrual basis accounting can sometimes lead to higher tax liabilities because you're recognizing income before you receive the cash. So let's talk about that. What do I mean by that? Let's pretend for a second that you use accrual basis accounting and it's December 31st, which is the end of your fiscal year. You might have income that you've recorded, but you haven't actually received that money yet. And you are going to get taxed on that as income, regardless of if you've actually received it. So that's just something to keep in mind. But then again, on the flip side, this method can also allow you to deduct expenses before you've even paid them, potentially reducing your taxable income. So let's say you receive an invoice for something on December 28th, which is inside your same tax year. You're able to record that as an expense right then and there on December 28th, but maybe this invoice isn't due for 3 months. And so that money hasn't left your bank account yet. You still get to include that as an expense in that year. So those are just a few pros and cons to keep in mind there. Hopefully by this point, you have sort of got an idea of which method would be best for your company. So let's talk about making the transition from cash to accrual basis accounting. Let's say you finally reach that $25 million threshold. So by law, you are required to make the switch from cash to accrual basis. What is that going to look like for you? Well, switching from cash to accrual, it can be challenging, right? So it's essential to consider everything very carefully. This could, in all honesty, be an entire episode on its own, and I may do that later. So if you're listening and you think that's something that you want me to discuss, please let us know on our socials. But for now, let me just give you like a quick overview of what that process could entail. And just keep in mind that this is a brief overview. So in most cases, I would say transitioning from cash to accrual basis accounting oftentimes can involve tracking 2 sets of books for a while just to ensure that you are recording everything properly and you're complying with the right tax laws and financial reporting requirements. If you're making this switch, you need to take a look at your existing balance sheet and income statements to determine how you currently report assets, liabilities, revenues, and expenses. Next, you'll need to find any accounts that require a cash to accrual adjustment. And generally, you'll need to add some new counts to your chart of accounts, including accounts receivable, accounts payable, as well as any prepaid accounts for both income and expenses. And then finally, you will have to actually make those adjusting journal entries to convert from cash to accrual basis accounting. Under the cash method, a sale made where payment has not been received would not be recorded on your accounting records. So under the accrual method, the sale will be included as revenue with a corresponding accounts receivable that will remain on your books until the cash payment is received. So you'll have to make entries like that to get everything correct. It might sound simple, it might sound complicated to you, but it's just important that if you are having to make this conversion, that you go into it with your eyes open and understand that even though the transition can be tough, and you might need some outside help, like an accounting firm, it can be done, right? So just some final thoughts as we wrap up today's episode. It's just crucial to emphasize that there is no one size fits all answer to cash versus accrual basis accounting. The right choice really depends on your unique business circumstances, goals, and compliance requirements. As always, I recommend consulting with a qualified accountant or financial advisor who can help you evaluate your options and make the best choice for your business. Remember that the accounting method you choose can impact your financial reporting, your tax obligations, and just honestly, your overall business operations. So take the time to make an informed decision. Thank you for joining us today on Accounting Recounted. I hope this episode has shed some light on the decision-making process when it comes to cash basis versus accrual basis accounting. As always, if you have questions or topics that you'd like me to cover in future episodes, please don't hesitate to reach out either on our website or social media. And until next time, stay financially savvy and keep building your successful business.